if my insurance goes up, partly because of inflation and the cost of everything, the construction costs and the replacement costs have gone up because of inflation. So it trickles into insurance replacement values go up, and therefore insurance companies have to raise their prices. So kind of comes back to the transportation insurance, but it also means I have to raise my rents, because if I was charging, $1,200 for a 2-bedroom apartment, and now my insurance alone is going to go up, $60 a month, and my taxes have gone up. However, I'm going to have to raise my rents a little bit because of that.
I am starting to hear from my audience that more and more creators in the finance space are actually putting out content that says higher interest rates are actually causing inflation to go back up. I think that's an interesting concept. I will admit to dismissing it too easily. I've spent a lot of time thinking about it. I can see some threads to pull on. And anytime I have one of these complex economic things, I go to my good friend, Anna Kelly, so we can just rap about it and I can just be a little bit smarter. Anna, how you doing?
I'm doing great. How are you doing?
I'm doing really, really well. I don't know if you've heard, I don't know if you've watched Ken McElroy's or maybe some of your other advisors that are in your circle. There's a pretty strong talk track today that higher interest rates are actually leading to inflation picking up, which maybe is just coincident timing, right? The first 3 months of the year, we've had hot inflation readings as rates have gone up. Rates have gone up more since, right? Now with mortgage rates over 7, the Treasury over 4, 6, whatever it is. So I don't know about you. Have you given this any thought? What are your initial thoughts? Higher rates
I
causing
have.
inflation?
Yeah, I've given it a lot of thoughts. I'm on Ken's email list. I'm friends with Ken McElroy, but I haven't actually listened to his video. I think he did a show yesterday talking about this, and so I haven't seen it. But I have been thinking. I've heard some rumblings that there are, even some people on the FOMC, the Fed's Open Market Committee, that's trying to help determine where rates go, that have been talking about this a little bit in terms of housing. And so I will, if you haven't listened to video 1, go back and listen to video 1, because I'm doing a webinar tomorrow to help people figure out where we are in the economy. And because of that, I've been really digging deep. I have been already, but really digging deep into the last reports, the FOMC reports and reports coming out of different government entities for the data for 2024 specifically. And if you look at March 2024 data, even though inflation has gone up, there are certain sectors of the economy where it's still going up, and most of the economy, it's actually coming down. So I'll give you a little teaser relative to this particular topic, but the only areas that are really still going up when you dig beneath the hood of where are the numbers inflationary are primarily 3 areas. It's transportation, but the transportation piece is all insurance, auto insurance. Okay. Part of why auto insurance has gone up is because the cost of vehicles have gone up. The electric components are more expensive. And so if it costs more to replace a vehicle because of inflation, right? And interest rates play a part in auto, behavior as well, and people borrowing to buy the vehicle, that could drive up insurance costs to some extent as well, because costs of everything have gone up. So the replacement cost of insuring those things go up as well. The second area is actually gas. Natural gas has gone up over the last quarter, where oil has come down. And I apologize, I misstated that. It's electricity, not gas. Electricity has gone up, despite the fact that gas and oil have gone down. So I don't think interest rates have too much to do with electricity, too much, right? But the other piece that's really the largest component of why the inflation number was up is the housing component. And the housing component is really a messed up conglomeration of numbers that, in my opinion, inflate the amount of inflation that there really is in housing. Okay. So it creates owner's equivalent rent. And owner's equivalent rent basically assumes that if you own a house and you wanted to rent the same house today, what would it cost you to rent that same house? It doesn't take into account that most renters don't live in owner-occupied home neighborhoods. They're usually renting less expensive homes. It doesn't take into account that leases roll over every month. And so they're not seeing that, the value of what they think their rent would be might actually be less than what they could get today. And there's all kinds of other things that it really doesn't take into account, but there's a lag. But here's the thing about housing. We know this as landlords. If my expenses go up, and they have, my insurance has gone up 30 to 40% in the last 2 years just to insure rental properties or apartments. Apartments in Houston, Michael, insurance has gone up 500%, from $300 a year per unit to $1,500 a year per unit. I'm not making this up, like
Wow.
crazy amounts. So if my insurance goes up, partly because of inflation and the cost of everything, the construction costs and the replacement costs have gone up because of inflation. So it trickles into insurance replacement values go up, and therefore insurance companies have to raise their prices. So kind of comes back to the transportation insurance, but it also means I have to raise my rents, because if I was charging, $1,200 for a 2-bedroom apartment, and now my insurance alone is going to go up, $60 a month, and my taxes have gone up. However, I'm going to have to raise my rents a little bit because of that. So that is impacted by rates because inflation is up, but it's also impacted by the fact that my debt service has gone up. And this is the bigger piece where I think that probably Ken is thinking through when it comes to housing is, if I'm paying a mortgage, and most people don't understand this, but unless you live in your house, most people have commercial loans on their real estate, their rental property, whether it's apartments or even whether it's a single family or a 4-unit, because lots of people don't know about DSCR loans like we do, Michael. So most rental property loans are rolling where they only lock in your rate for 5 years. And after that first 5-year period, the rate resets every single year on the anniversary. So if and I've done calculations on my entire rental portfolio of close to 300 units that I own locally, okay, not including my syndications, but for my properties, if my rates reset from the 3.25 to 3.99 that most of them are today, when those rates reset, if they reset today, they'd be in the 7 to 8.5% range. So literally more than double what I have today. So my mortgage payment goes up because interest rates are kept higher by the Fed. If my mortgage payment is doubling, I absolutely have to raise your rent in order to make a profit. And what most people don't understand is that the average landlord keeps 9 cents of every dollar as profit. That's it, if they have a loan on it. So if my 9 cents of every dollar of your rent is now 4 cents, I'm not even beating inflation. So I'm going to have to raise your rent. So because of that, the Fed keeping rates higher keeps mortgage rates higher, keeps most rental property values down, but yet payments way up, my debt coverage ratio payments, which means I have to really jack up rents. And here's the last piece. I know this is a really complicated and long-winded response, but we see that in rent. So we think about that with real estate, but you also have to understand that most corporations also have rolling debt. So just like rents are higher, meaning rental inflation is higher, and that's keeping inflation higher for most people on their most expensive payment that they have every single month, plus the insurance that goes along with that. When you're talking about retail shopping, you're talking about food, etc., you also have companies who have debt. And so their debt is also rolling over, just like it is for real estate investors. So their debt coverage payments are going up. And so if they want to keep profits, they've got to pass through those increases in their debt service costs that are directly impacted by the Fed rates. So to the point of, are rates keeping inflation high? It is in the most important sectors that most Americans spend money on. Transportation because of the insurance, housing because of both the debt service and the insurance, and then other things, they're pushed. So when the Fed cuts rates, although there's a fear that inflation could rage because asset values are going to go up and people are going to invest in the stock market, for the average homeowner and the average renter, that's 66%, check to check. If debt service falls, hopefully most landlords and most companies actually lower rents a little bit versus maybe they're jacking them up now in anticipation that their debt is rolling over. And that could be deflationary and actually bring inflation down rather than the other way in the things that make up the biggest percentage of inflation.
Yeah, I think there's kind of two other things that I noted when I started to think about this. The other one is obvious to us because we're in the thing, but higher rates will temper supply, right? We're already seeing
Yes,
in the commercial space, but again, I've spoken to small time infill builders, right, who buy a lot here, a lot there, and do their thing. Their pencils down, right? They don't want to
100%.
play. Construction loans are 12%. And they're like,
Yes.
nope, I'll just keep my money in the bank. I'll wait, I'll wait. So again, not
And
only,
50% LTV, 50
yeah,
to 65%, not 75 or 80 anymore. So I'm developing properties. We're on hold for most things other than where we can get HUD financing, which takes a year, even to get the pre-approval letter.
mhm,
So, to your point, yeah, it's very, very costly, which drives down supply. There's not going to be as many new units on board. And
mhm,
if supply comes down in areas that aren't oversupplied, then prices go up for
yeah.
sure.
And then the last one I was playing with is, we've talked about the bifurcated consumer, but it's fair to say that the top 20%, right, the ones with the discretionary income, as you said earlier in an earlier video, a lot of those folks are already pulling back, right? They're conserving because they see some troubled waters ahead. But for the first time in my adult life, or at least the last 20 years, we're earning 5% or more on our cash,
Right.
right? And if you got a big pile of cash, that's like real money. That's thousands of dollars potentially a month.
Yeah.
So again, they're the folks who have assets, who have cash in the bank, higher rates. It means they're actually producing, real income off their savings for the first time in a while. So that could be considered inflationary as well.
Yeah, I have to think through that, Michael. Typically, if you start incentivizing people to invest,
Hmm.
that creates growth, which generally leads to inflation. So,
Hmm.
generally speaking, when you pull money out of investment, investing in buying more property, you pull out of investing in creating businesses, it tightens the money supply that's actually productive
Hmm.
and it lowers GDP. As people stop spending, that does bring inflation down. So I think at a high level, and I'm just
Yeah.
talking off the cuff early in the morning, but I think more people saving actually does help bring inflation down versus the other way
Okay.
around.
Yeah. I was looking at the interest payments being a source of spending. That's where I was
Oh,
looking.
right. I see what you're saying. So if I'm not saving money, I might still be investing and paying higher interest payments, which could, drive
Yeah.
up. So yeah, and
Yeah.
and it's complicated because
Yeah.
it depends, but generally speaking, the key tools of Fed are either to pull it's to dump a bunch of money into the system
Hmm.
and really lower rates to keep people from saving so that they will
Invest.
invest and
Hmm.
create growth. So as soon as rates are up, it actually does slow
Hmm.
investments and growth because we want to save instead of why
Yeah.
am I going to build an apartment building, for example, when I might make 5% on my money but with significant risk and years of headache and
Mm.
my life. If I can park my money at 5%, I'm just
Yep.
not going to create that supply. And so from that standpoint, if I'm saving a whole bunch and not investing it and it brings supply down in certain areas, that will, to your point, drive up inflation and the cost of those goods that are undersupplied for. And this is why it is complicated to look at
Hmm.
where is inflation and where is GDP because different sectors are impacted differently. And those that are most impacted by interest rates are the ones that, you still see this high inflation because of the debt service payments, where areas that aren't as seasonally and quickly impacted by interest rates, you're starting to see, people start to pull back because those things that are impacted, by interest rates are taking so much of their monthly income to the point that higher interest rates are creating more inflation and those key things, that they just simply can't afford the other things. And then prices for that and inflation for those other things start to come down. That's exactly what we're seeing in the data.
So good. Anna, where can people find you?
Great. You can find me here on your show every week on my playlist on your channel. Social media, Anna Kelly, REI Mom on Facebook and LinkedIn. And you can find me at my website, Anna Kelly Investing for coaching and consulting.
Thank you so much.